and affiliation. We are webcasting this press conference, so we ask that you please use the wireless microphone. Just raise your hand and my colleague Jill will bring it to you. We'll do one question and one follow-up to ensure that everyone gets a chance, and if we have time, we'll go for a second round. Thank you.
Hello, Greg Quinn with Bloomberg. You mentioned how models have struggled to pick up some changes in the economy lately. You recently changed some of your models around exports. How much of your current view on the potential for exports rests around the reliability of the new models, and how much rests on judgment of uncertainties?
Well, a forecast, Greg, is never free of judgment. And as I said in one of the answers today, just picture a data point. The data point's arriving, and one's above, the next one's below, the next one's above, the next one's below. You kind of that. So any given, your latest observation tends to be not on the line from your model. And so it requires a certain amount of interpretation. Is that just because of a fluctuation in the data that's going to probably go away next period? Or has it been 2 or 3 in a row that have been below the line or above the line, in which case you might need a richer story to understand the error terms, and they need a richer story about how they will go away, or if they will go away. Sometimes, like back before we did this new modeling, we were coming up short, as you know well, of the exports that the model was predicting. And so at a certain point, back in 2013, actually, we decided, well, we'd better take those shocks as a permanent error term. We must assume that the model is probably due to destruction of exporting firms, et cetera. Therefore, we're going to assume that the error term in the model is permanent, but our new forecast will be parallel to the old forecast. So that's what we would do while we're waiting for a new model to be developed. So today, having gone through a very extensive review of possible models, and have gone in 2 different directions that can be complementary to one another, we've got a high degree of confidence that we've done everything we can, and that there are still things around the competitiveness story which aren't strictly modelable that we've mentioned in the past. Regulatory barriers, perhaps. Some other structural changes in the manufacturing sector, those kinds of things that we can't really capture as an empirical regularity. So there will always be judgment there. But primarily what's happening now is the growth rate of exports that we have in the forecast is what these models predict. Okay, so it's on the order of 3% growth for exports, which is much lower than what we've been working with in the past. And that takes account of the lower weight on the U.S., different weights on various ingredients, and more weight on the other currencies, the multilateral concept of an exchange rate.
You also mentioned, of course, that inflation has been below target for a while. How much of that is related to something that models aren't picking up, or related to just specific shocks that are hitting the economy?
No, in the case of inflation, it's been below target because the economy has had excess capacity, and that linkage appears to be reasonably intact. So you have to go back another step. Why is the economy still below full capacity? Well, the main reason is because we were on our way to full capacity, and the oil shock came along, and that set us back 2 or 3 years in that convergence process. And so I think the relationship between the output gap, or excess capacity, and inflation stands up to scrutiny. It continues to be what we've been using. So that's not an error term in the model. It's because the economy has not picked up speed as much as originally we thought. Once the oil price shock came along, then we had to remodel the whole trajectory. And I think the economy has performed reasonably closely to what we said when that early in 2015.
Pushpa Balgobin from Reuters. You touched on this slightly. You noted the impact from the government's infrastructure stimulus has yet to show up in the data. How confident are you that we'll see the data this year?
Well, so the real place to see the full effects of government programs on the economy is in the national accounts, which are quarterly, and the latest is from the third quarter of 2016. So there's a substantial lag there in the program. In fact, if you go back, the agreements that each time the government signed an agreement with a province, they announced, okay, we've settled how the infrastructure funds will be delivered and for what projects in this province, that province, and so on. Many of those agreements weren't signed until in the summer. So there really isn't much of a chance for those parts to show up until the fourth quarter. And we'll have the fourth quarter data, and I guess in another month or so. And really, the full effect probably won't occur until the 2017 data. And so that's where we were looking for the biggest effect in the first place. Now, the other major program there was around the child care, Canadian Child Benefit. And there we could see a pretty significant impact of that in the third quarter data. So we know that is already landing. It started July 1st, and so we started it virtually right away in the data. So I think as we get into the 2017 data, which remember is a few months after the fact, we'll have a very good reading on whether the infrastructure spending is coming in as strongly as modeled.
You touched on childcare, but what other indicators are on?
Other indicators of?
Where do you expect to start seeing everything happen first?
Well, the main thing, the infrastructure program will show up in certain indicators around construction indicators. But the main place where you can put a full picture is when you get the national accounts. The national accounts give you the full the full add up of what adds up to the economy. And so the government part shows up very clearly because they've figured out all the other parts. In between national accounts reports, we're just using monthly indicators to help us guess what's coming next or forecast what's coming next to monitor the situation. But the full picture really only comes 4 times a year. So I'm just saying that in a month or so, we'll get the fourth quarter data. That'll give us a better reading than the third quarter. But I really think we have to wait until into the 2017 data, the first quarter or second quarter, to get the full picture of how that program is impacting the economy, which is quite some time from now.
Justin Giovanetti from the Globe and Mail. Do you have a sense of what the cost will be to overhaul the computer models?
No, I don't really. We have a very exceptional research staff capability in the bank, and those folks are always doing research on issues that in one way or another will connect to our modeling efforts. They may be standalone kind of topics. They're not building a brand new model, but rather building insights into the parts of the model that we have now. And usually what happens is, as a separate endeavor, people are investigating what alternative structures, what models, what could we do to make our current model stronger? Are there things missing from it? I talked about heterogeneity, for example, assuming that all households behave the same or all firms behave the same, which is implied by the model. Well, we know that's not true in practice, but how bad of an assumption is it in a macro model? That's something we need to test, and so this is just one example. So there are some things that we're doing currently that will add to or change parts of our structural model, the total that we use today. And there are separate research agendas which would bear on completely new models. But all that sort of is more almost like an organic process. It's not like a structured task force, let's go get this done. But it is to give the staff the creativity, the license to be creative and think through things, and then actually invest in new efforts on the models, and not to worry if for some reason that experiment doesn't quite pan out as we expected. That will still help us to understand better how to use our current model. So I can't put a number on that. We have a staff that's exceptional, and they're working on research all the time, publishing all that stuff that you can read up on. And some of it is hard for you to see exactly where it would fit in a new model, but I can assure you that it all fits someplace.
And has the BIC ever modeled, I guess, the kind of news coming out of the United States over the past week in terms of immigration and refugees and what impact that could have on the Canadian economy?
So, yeah, we have a fairly robust U.S. model. And so, as I was discussing for the case of Canada, there's a view in there on the potential growth rate of the U.S. economy. And buried within that are key assumptions around labor force growth, productivity. And the labor force growth is driven by both natural population growth in the economy and immigration. And so those things all fit together within our model, and if you change the assumption, let's say, about immigration, then that will affect that assumption about the trend line for the U.S. economy, what its potential growth rate is over a longer time frame. The hard part in all that is that's actually fairly simple to do, but the productivity part is the hardest part, which is a very noisy variable, and one which is driven by discoveries and new technologies and just investment, capital deepening investment. So potential output is one of the most difficult parts of our economic forecast. It's truly full of assumptions, but there are, of course, educated assumptions based on supporting research. But that is where those kinds of shifts in policy would show up in our forecast for the U.S., and anything that has an impact on the U.S. will have some form of spillover on Canada. And that's, as I was discussing about, for example, the fiscal change that we modeled in the NPR, we went through all the various layers of how that would feed back on Canada and showed how there would be several offsets, so it wouldn't have a full one-to-one effect on Canada. And the same would be true for things that affected potential output in the U.S.
Gordon Kent from the Journal. Are there any concrete impacts of you not having the absolute best model that you would like to see? Things you can point to sort of the average person in the street? In other words, why should anybody care who's not an economist?
Well, that's a good question, I guess, because, as I said at the end, even though we've gone through a lot of models over the last 25 years, inflation has been pretty close to target throughout that period. And so we've managed to not go meaningfully off track. So the models have done their job. And so in that sense, it's like an underlying technology. It's like plumbing in a hotel. As everything's working, everybody's fine with it. So for us, it is kind of a specialist kind of zone where we're trying to make it better, and if possible, what we're trying to do is to bring areas that are currently highly judgmental and make them more mechanical, that is, more modeled and therefore automatic, as opposed to, a new assumption each period. So that's standard practice. That's why, in the old models there was all kinds of that, and now there's less because we've got a lot more detail in these models and the computers to be able to run all that detail. So I can't put my finger on something specific that's had. I mean, the closest thing would be the export story that I think is reasonably well known. That your models are based on behavior over, let's say, 20 years or 25 years, And then along came the global financial crisis, and along with it, a strong Canadian dollar, like rising oil prices and a strong Canadian dollar. And that combination led to the kind of structural change in the economy that, you can't capture in a basic model of exports. And what you had was companies actually leaving the sectors, exit, capacity destruction. So what happens then is in the new era that we found ourselves in, the economy didn't respond to the subsequent fall in the Canadian dollar the way our model would predict, because many of the companies that would have responded are no longer there. That's a pretty simple way to characterize it, but so the work that we've done in the last few months and published 2 weeks ago is an attempt to replace that modeling and to capture those kinds of underlying structural changes so that if such a change happens again in the future, that the model will automatically do a better job of tracking it. There's no guarantee that it will, but at least it's got a better chance than the old version. So it's a good example, but it's a very compartmentalized example. So in the kind of discussion I had today, it was primarily about the big picture modeling of how the economy interacts across its sectors. And that modeling has gotten better and better through time, and better both in terms of understanding how those forces interact and at predicting. And so that's progress. So you shouldn't lose sight of the progress while focusing on the fact that even exports, our models explained like 90% or 85% of the action. So it wasn't like they failed us, they just didn't quite catch all the nuance that was out there. And so we were on it reasonably quickly, trying to understand where that hole was coming from and what might fill it. So.
We have time for one more question. Anyone else have a question? Greg?
Within this, there's talk of an end point or getting back to normal with all of these changes hitting the economy and modeling. How hard is it for you to talk about the end point and when Canada gets back to something called normal?
Well, we're fairly certain that whatever normal we arrive at will be a new normal. Enough fundamentals or structural changes have occurred for us to understand that. And that's why I used the word reinventing. I've used it in previous speeches. Reinventing central banking means, in effect, changing the set of things that you look at day to day and having that same shift reflected in or captured in your models. And so in particular, what we all missed during the, say from 2001 to 2006-07 was the accumulation of debt, particularly in the U.S., and leverage more generally in financial markets. And so the exotica that were created in financial markets were forms of leverage. And so it's not just households that were leveraged, but financial markets were extremely leveraged. And so what you could observe all that, and it all kind of looked unusual, but, didn't have a macro consequence in our models. We would have had a hard time explaining how much growth there was in consumption through that period, in the U.S. in particular, leveraged consumption. Now when we look back at it, we say, well, it's probably got to do with a shift in psychological shift in the wake of 9/11 and how people responded. They levered more and they spent more. And it was facilitated by the financial sector. Lots of new ways to leverage. And so in the end, of course, fed housing and all those things. And so we had this excess and it got unwound. And it's been taken several years to recover from that. So going above all that would not be well explained by our conventional models, or a model like QPM, for example. for that matter, really totem, nor the aftermath. Now, provided that, our new financial regulatory architecture prevents such shocks from happening again, that may be okay. But we want to make sure that we understand those dynamics and that we've got them modeled as best we can so that we do see it coming and act appropriately in advance next time around. So that's, a pretty big objective. But I think it's a big objective, but it's manageable. So right now we work with the model I mentioned, MP2, which is just, a relatively small thing, but it has those macroprudential actions like, debt limits for mortgages and stuff like that to try and analyze how those things would interact with the economy. So that's just the beginning of an interface between those issues and the standard macro issues that a fully articulated synthesis model would have. And so that's our objective in this reinvention phase. And there are other things that I mentioned, like heterogeneity, those kinds of things that we need to at least understand whether they're important or not. Okay.
Thank you, Governor. That
Yeah.
concludes the press conference. Thank you very much for coming.
Thanks, everybody.